Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hello and welcome to Kitco with me, Paul Harris, here at the 2025 Rule Symposium in Boca Raton, Florida. We're coming to the end of a very, very busy week, and it's been a great week. And I have great pleasure to be joined by our host, the one and only Rick Rule. Rick, thank you very much for joining us this afternoon.
Paul, thank you for having me back.
I think you've done an excellent job, Rick, this week, Rick. The quality of the companies, the quality of the panelists, the speakers, phenomenal. Even to the detail of here in the hotel, we've had lots of birds flying around going cheap, cheap, cheap. Nature indicating that gold is still very cheap, that gold stocks are even cheaper on a relative basis. And that was something you touched upon in one of your many sort of sections during the program. On a relative basis, a lot of gold stocks, Agnico Eagle Mines, I think was your reference, are cheaper today on a relative basis than they were at this conference last year.
So let's unpack that. I would make the argument that gold is cheap. Gold does well when people are concerned about the maintenance of their purchasing power in fiat currencies, in particular the US dollar. I would suggest that as a consequence of the deficit, that the US dollar repeats its performance of the decade of the 1970s, where it lost 75% of its purchasing power. If that's true, it wouldn't surprise anybody, I think, if that's true, to see the gold price mirror the decline in the US dollar, which is to say go up threefold or fourfold. How far has gold come? Yes, it's come a long way. Remember how far gold ran in the decade of the 70s, the last time the US dollar lost 75% of its purchasing power. In gold bull markets, gold stocks follow gold. Gold has moved, but the gold stocks, with the exception of the biggest and the best, haven't moved very much at all. The biggest and the best have moved, which is indicative of about the first quarter of a gold bull market. The best of the best moves, then the best of the rest moves, then it goes down the quality chain. You're seeing farther down the quality chain, you are seeing the best of the tertiary companies in the space. They haven't moved yet at all. They are in fact cheap if we're in a gold bull market.
Now, I want to follow up on the theme I mentioned about Agnico Eagle Mines, taking them just as not necessarily as a random example, because they're the biggest and best gold company at the moment. Their share price is up, let's say 100% over the past year. The gold price has gone up to $3,300 per ounce. How can they be cheaper today than they were a year ago?
My argument is that if you took a net present value of them a year ago with the gold price that existed a year ago, the net present value of their free cash flow at $2,200 gold means that their free cash flow valued at $3,300 gold. In fact, if you do price cash flow or price net asset value, they're selling at lower multiples today at a higher price than they were back then. The margin that they earn at today's gold price is so much higher than the margin that they earned at the gold price that existed then, that despite the fact that the stock is up 100%, by any reasonable valuation metrics, they are cheaper now than they were then.
Okay, one of the key talking points that many of the speakers and keynotes have got into this week really illustrates how polarized the political divide has become. And of course, I'm referring to President Trump's big, beautiful bill. We've had people such as Jim Rickards, defending it, being apologetic for it. We've had other people such as David Stockman really poking holes into it and really going to great length to explain the maths and what the mathematical outcomes of that are. Was that a conscious decision to program people from the, for and against?
Absolutely. You'll notice that in addition to that, rather than just having gold bugs here, we brought in Joe Littman. The idea is that there's supposed to be a contest of ideas here, so that our attendees can decide what macro themes they believe in and adjust their lives accordingly. In the dispute between Rickards and Stockman, although both gentlemen are friends of mine and both gentlemen have been speaking for me here for 15 years, I was much more persuaded by the Stockman argument. The Stockman argument seemed to be founded in arithmetic, and the Rickards argument seemed to be founded on narrative concerning the future. I'm always, as a lender, more persuaded by math.
There did seem to be a bit more wishful thinking in the Rickards hypothesis than in Stockman's.
This is going to happen, and Stockman said this is the arithmetic. Now, Partially because Stockman gave a much more sophisticated version of the speech I gave on the opening day. I was more prepared to accept his speech since I had given it.
I guess the key thing, though, is what does that mean for gold going forward?
If it would appear to me that the circumstance that we're in the United States, with $37 trillion in on-balance sheet liabilities, or as Stockman pointed out, $29 trillion net of the Fed's own balance sheet, and $100 trillion off-balance sheet liabilities, it would appear to me and to David that the only way that we honor the nominal value of our obligations is to devalue the purchasing power of the dollar. We did that in the decade of the 70s. The Office of Management and Budget, which he was the head of, tells us that in the period 1970 to 1980, the US dollar lost 75% of its purchasing power. That's what I think happens over the next 10 years. In the 1970s, the gold price ran 30-fold. I'm not suggesting the gold's going to go 30-fold. I'm suggesting that if the performance of gold mirrors the negative performance of the US dollar, that the gold price could run 3-fold or 4-fold. That's what I'm suggesting.
Now, I had the pleasure and privilege to be here last year. One of the key themes that people were talking about last year was interest rates, interest rate cuts, and the impact that will have on gold. That element of the debate has largely been absent this year. Why do you think that is? Is there a certain fatigue, or is there certain people see the eventuality it's going to happen, so they've already mentally dealt with that?
No, I think it should have been more of a topic of discussion. I'm surprised that there wasn't more of a discussion of interest rates on the macro panel. It would appear that there's intense political pressure on the Fed to lower the interest rates. At the lower levels of the Fed, the Federal Reserve believes that they're the only institution of the US government that's involved in defending the dollar. They believe that Congress has totally lost the plot, and it's only the maintenance of relatively high interest rates that's defended the dollar. I remember myself very well in the decade of the 70s, when interest rates were allowed to rise some to kill inflationary expectations in 1975. That rise in interest rates was fairly steep, and it really cracked the gold price for 9 months. It also cracked the equity markets, obliterated the debt markets, and hurt the housing markets. When the political forces lost their courage, cut interest rates to re-stimulate the economy, gold was off to the races. Wall Street knew the government is not going to defend the dollar's toast, here comes gold. If they succeed politically in causing the interest rate to fall, the gold market will take a real romp, similar to the romp that it took at the end of 1975 through 1976.
Well, President Trump has certainly made no secret of his desire for interest rates to be cut. He's put a lot of rhetoric out there, putting pressure, as you say, onto US Federal Reserve Chairman Jerome Powell. Now, reading the news this morning, Republican lawmakers are also investigating avenues that they could potentially take to put the similar pressure onto him. How do you think this is going to play out?
I suspect politically, given that the Fed is a politicized institution, I suspect, I don't know, I'm not really a Washington watcher, I suspect he'll cut interest rates.
Okay. What is the big deal with interest rates? I mean, for those that perhaps don't necessarily fully understand the implications, gold's at 3,300 US dollars per ounce. It's hit 28 all-time highs this year. It seems to be doing very well, thank you very much, regardless of what's happening in the interest rate sphere.
The interest rate is the compensation that private sector investors receive for tying up their money and for inflation. And this is really the crux of the issue. If you believe the federal government's measure of inflation, the CPI, you're in fairly good shape. You are getting paid 4.5% in the US 10-year Treasury in a currency where your purchasing power is declining by 2.5%, meaning you're making a 2% real yield. I don't happen to believe the CPI. When I look at the basket of goods and services that I consume, Paul, or that you consume, my belief is that the underlying rate of deterioration of the US dollar is more like 7.5 or 8%. If you cut the interest rate too much, what happens is that the attractiveness of US dollar-based savings declines. Money flows out of US dollars into competing currencies or into things like gold. As the interest rate falls and the currency weakens, gold does well. Now, it's interesting that at the same time that Trump is for lowering the interest rate, he has also said that a lower US dollar would not be a bad thing. in terms of export competitiveness. We saw this before in the decade of the 80s, where there was successive currency devaluations by various governments. One of the things I like about gold is it is one of the few mediums of exchange in the world that doesn't have a domestic political constituency for devaluation. If we devalue the dollar, our exports become more competitive in Europe and Japan, which gives them an incentive to devalue the euro and the yen, respectively. What's lovely about gold is, as I say, there's no political constituency for devaluation. Among other currencies, on occasion, you have an incentive for a race to the bottom.
Now, failure to devalue the currency is one of the key tenets of Trump's trade spat with China, but perhaps that's something to get into another day. Finishing on the interest rate theme, Rick, a couple of the speakers mentioned that, they see that the US is going into recession. I think one speaker said, when you actually look at the data properly, we're already in recession. The US is already in recession, under which circumstances, far from cutting interest rates, there may be a case for increasing interest rates. What would you make of that?
Paul, I'm no economist. I'm a lender. When I look at the oil price and the natural gas price, despite no measurable surge in production, perhaps a temporary peak in the United States in terms of Permian production, if you look at price weakness in the oil and gas business, despite stable supplies, that tells me that we may be in a recession, not approaching a recession. The fact is that supplies aren't rising, prices falling, which tells me demand is falling. Demand for energy is extremely economically sensitive. So while not an economist, I look at the signs reflected in the copper price, the nickel price, the oil price, the gas price. That tells me, at least in the near term, that demand is very, very soft, which is an indication that the economy may be softer than people suspect.
Is there a case for rising interest rates?
I think there's a lot. I think the principal case for rising interest rates is inflation. I think that savers deserve more yield on their savings. I think the fact that the federal government is attempting to manipulate rates down tells me that the market wants them higher, not lower. The political forces in the very near term can overwhelm the market. Remember that in the long term, the market is a weighing machine, not a voting machine. Remember, too, during the reign of Bill Clinton, that he described a group of people called the bond vigilantes, which is to say the global savers. Over time, and you see this in the United States right now, despite the attempt of the Fed to lower the near-term rate, they've lost control of the long-term rate. The long-term rate seems now to be the province of the market as opposed to the politicians.
Okay, now you've had more than 1,400 attendees at the event this year, both in present, here in person and via the live stream on the internet. This is very much created as an educational event. What's one thing you've learned this week that you perhaps didn't know before?
What's attractive to me is the increasing quality of the audience over the years. We've been putting on this thing for almost 30 years. The audience gets better and better and better. It isn't just that the audience gets bigger. The audience this year is much more experienced than last year, and that audience was much more experienced than the year before. What's changed this year relative to last year? I mean, we put on a great show last year, and we had a great group of exhibitors, and they were greeted with a good market. People made a lot of money last year, which brought them back to this conference with more ambition and frankly more money. What's changed this year is that when you walk through the aisles, you're seeing a lot more commerce taking place. Last year you saw a lot of study taking place. This year you're seeing commerce taking place. That's different.
Well, Rick, congratulations on a great event this year. Rick Rule, thank you very much for joining us today.
Thank you for your contributions to our success.
And that's all from me for now. I'm Paul Harris, and this is Kitco.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.